Let me welcome on board Pramod Gubbi as well and find out what he's making of the market right now. Pramod, hi, afternoon, and what a crazy week this has been. I mean, how do you even describe what happened on Monday with the euphoria, Tuesday with the crash, Wednesday again with the recovery, and now think about it, we're almost closing in on the lifetime high.
Yeah, indeed. That's what markets are. They are volatile. They never go up in a straight line, and that's what makes it interesting as well. And that's what gives opportunities to make money. These inefficiencies and these volatilities are part of investing. And the more you embrace the volatility, the opportunity to make money is better. But yeah, I mean, it's been a crazy swing this week.
Capitalize on this opportunity this week. What's been the action?
Sorry, could you repeat your question?
I'm just saying, how did you manage to kind of tap into this opportunity that the market threw up in terms of making money? What was the action like this week at Marcellus?
Well, I mean, we are known for our inaction. We're long-term investors. We rarely react to such events, and that's been the case this week as well. We have barely changed any of our portfolio positions. But going into a volatile event, our style of investing, our sort of portfolio, which is comprised of strong businesses, fundamentally with strong balance sheets, always tend to do better in times of adversity. So we went into the elections quite strongly positioned for a potential adverse event. But it was not because we expected any adverse event. It's just our style of investing. So to that extent, there's been almost next to nothing in terms of changes that we've made pre or post elections.
Okay. But what have been your portfolio overweights, if one can ask that?
Yeah, so I mean, look, we remain bottom-up investors. For us, the business has to make return on capital greater than cost of capital to even come into our radar. Of course, given the direction of the economy, certain sectors are better positioned because it adds a few percentage points in terms of the growth from the near to medium term perspective. And to that extent, the portfolio has been leaning towards increasingly towards capital goods and industrials. Of course, the pocket where we have seen the best combination of growth and value have been private sector banks. That remains a reasonably large allocation for us. Healthcare services remains a decent allocation both across hospitals, diagnostics, and pharma. Consumption has been an area of interest throughout for us. Consumer discretionary, in particular, we've had a decent exposure. And hopefully, we expect that to make a comeback in terms of growth. Valuations have become attractive, but growth has been elusive. But I reckon in the coming few years, we can expect a recovery on that side as well.
Point taken. So you've been overweight consumption, still like the capital goods space. But we were just hearing the speech from the Prime Minister just an hour ago, Pramod. And he kind of reiterated the fact that it's going to be the pace of reforms, but an accelerated pace of reforms. And all of those top highlights will come up for you on the screen. And he also talked about how the new NDA will stand for new development, aspiration will be a lot in terms of the middle income as well. And they'll continue their focus towards manufacturing and, providing affordable housing, all of that. What's your own expectation? Is there going to be a bit of a shift in policy and hence a reset in terms of the sector churns? Or do you think it's going to be more of the same, as you said, capital goods and manufacturing, etc.?
I think by and large, it'll be more of the same. This government has been pretty strong in terms of execution on the reform front, execution of public sector capex, public sector infrastructure. All of that is having a knock-on effect on private sector capex. The focus on fiscal consolidation is particularly appreciated. The only thing I reckon the government might take away from these election results is boosting consumption and employment. So far, a lot of the capex activity has been in capital-intensive sectors. There might be some policy action. I'm not an expert, but if I were to read the takeaways, there is some policy action required on labor-intensive manufacturing. To that extent, moving from production-linked incentives to something like employment-linked incentives could be a tweak at best. But otherwise, I reckon it'll be more of the same. The pace of reforms also could be at the same pace. I don't think there would be any sort of hindrance on that. But yeah, the focus on consumption and job creation could be a lot more than the past.
Right. Okay. Pramod, I guess you know what's critical is also to understand what to avoid and what not to venture into in a market like this. And many have been debating whether PSUs have run their course and whether they're going to go into a long patch of, price adjustment. Are we going to see some time-wise correction, perhaps? How is it that you're looking at this entire bunch?
Well, I think, like I said, we are bottom-up investors. It's bound to be the case that certain pockets have sort of gone ahead of themselves, or at least ahead of fundamentals, where the market prices are factoring in sustained growth, even in sectors which are fairly utility-like in terms of growth potential. So those pockets will obviously be at the most risk because eventually the markets will shift focus from narratives to actual fundamentals. Wherever there are thematic plays, either focused on defense, power, utilities, energy, and so on, eventually those narratives have to translate into earnings growth to justify the prices. I'm sure in some cases there will be earnings growth coming through, which can justify valuations. But there are pockets undoubtedly where valuations have gone way ahead of fundamentals, and that will be at risk. So I don't think it will be appropriate to paint all PSUs with the same brush. There will be some which can perhaps hold up, but clearly there'll be a lot of question marks on many as the earnings season comes after quarter with no flow through from earnings.
But since we are talking about valuations and risk reward, where does IT sector fall in that, Pramod?
Well, IT, most people look at it as defensive, but it remains sort of early stage cyclical, particularly sensitive to global interest rates. So to the extent that we've seen a peak of the interest rate cycle, the chances of cuts are higher today. In fact, starting last April, when the Federal Reserve signaled the peaking of interest rates, we saw a rally in IT in anticipation of potential rate cuts. However, that rate cut hasn't transpired, nor has any sort of pickup in terms of discretionary spending by global enterprises on IT. To that extent, we've seen a pullback of sorts over the last 3 months. Yesterday, with the ECB cutting interest rates, again, expectations of rate cuts have picked up, and hence, therefore, a pickup in discretionary spending. But unlike last March, valuations are not that attractive, even if you factor in some sort of a recovery in terms of discretionary spending and growth. I would say perhaps is in fair valuation territory with a little bit of fillip coming in should interest rates correct and expectations of growth pick up, given what we've seen over the last 1 year where companies have missed guidance, they've continuously downgraded guidance, and earnings haven't really followed up with the expectations that the rally last year suggested.
Hey, Pramod, good to have you on the show. And guess what? We've already made it to that all-time high on the Sensex. So yeah, what a magical mark. 76,762 is where we're currently at. And we're closing in at the high point today. It's a solid 2.25%, almost 1,700-point move that the Sensex alone has clocked in. And especially in this kind of a tumultuous week when we've had many such great days. Case in point being both Monday as well as Wednesday.
If you like this video, then like, share and subscribe to ET Now.